The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Sealing the deal for a Fed rate cut? Question mark. From Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Scarlett Fu. Let's kick you off to the closing bell here in the U.S. And this is what it looks like right now. So maybe we can answer that question that Romaine posed, because the S&P 500 resuming its advance, pushing it ever closer to its all-time high of 5667. That is the closing high, by the way, 5667. So we're keeping an eye on that one. Small caps, by the way, outperforming here the big caps, with all 11 groups in the green, led by materials companies. And a lot of movement in treasuries. We see treasuries rising. That is pushing the yield down, particularly on the short end. The 2-year, of course, the most sensitive to Fed policy, now down 6 basis points to 3.92%. And here's the Bloomberg Dollar Index. It gave up earlier gains and started to really sink after the latest Fed minutes showed that several officials saw the case for rate cuts back in July. It's now at a 7-month low. There's talk that hedge funds, of course, are using the dollar instead of the yen to fund their carry trades.
All right, we go back to, of course, two of the big numbers of the day. Of course, that 56.67 on the S&P 500 and 3.9 on a 2-year yield. That edge lower in Treasury yields really reflected of renewed wagers on Fed rate cuts. A doubling down, egged on by a downward revision to U.S. labor market data. Now, while this annual revision typically isn't something that moves financial markets, this year's update showed the disappearance of more than 800,000 jobs, the largest downward change going back to 2009. While there was some outsized reaction in the bond market, it was equity traders that were actually unfazed by this, buying out of yesterday's dip, pushing stocks up ever so higher. Equity investors might not be fazed, but consumers are looking a bit. Earnings reports from 3 major retailers out this morning, Target, Macy's, TJX, all showing Americans have become more budget conscious, with Target and TJX cutting prices to support their sales volumes, and Macy's posting a sales decline last quarter. I had a chance to catch up with Macy's CEO Tony Spring this morning, and he made clear that the rest of the year, in his words, will be rocky. Meanwhile, electric vehicle makers also taking a closer look at their pocketbooks, reassessing the high cost of production and parsing the flat line that we've seen in consumer adoption of the cars. Ford, the latest to recalibrate its electrification strategy, scrapping that all-electric 3-row SUV that it had promised, postponing a next-generation electric pickup, and shaking up its battery sourcing plan. So a lot of maneuvering right now amongst consumers, amongst corporations, and maybe investors alike too.
Yeah, it's a little bit of a scramble here, but let's go back to equities for a moment here, because I want to put the move in the stock market in context. It is mid to late August. We are past the main attraction in corporate earnings. It is a light data week and therefore light trading. The top panel is the S&P 500. The bottom panel is volume. And yesterday's dip lower in the S&P ended the S&P's 8-day winning streak, was the lowest down day of trading this year, and a clear contrast to the busy trading that we saw on August 5th right here. You can see that spike up in volume. Today is shaping up to be another light trading day, and for the next 43 hours, it is all about positioning for whatever Jay Powell says on Friday at Jackson Hole, how he frames the Fed's thinking on the labor market following that big annual revision in payrolls.
Yeah, and it's kind of interesting, too. We talk about some of the interesting quirks in the market here on this day, the rebound in stocks, but a rebound in the outperformance of small caps. The Russell 2000 up more than 1% on the day, about triple the gains that we're seeing in the S&P. What does that mean? Well, let's pose that question to our first guest. Darrell Cronk joining us right now to kick us off to the close. He's CIO of Wealth and Investment at Wells Fargo and Companies and president of the Wells Fargo Investment Institute. Got a lot of great titles, which is why we love you here. Offer a little perspective here, because there was this whole big trade that we had seen, at least prior to the whole blow up over the last couple of weeks, where we saw small caps sort of outpacing large caps. We saw a broadening of the rally. I know that kind of got interrupted here, but is that an interruption, or is that trade just over with?
I think it's really about valuation. The July trade was all about the political posturing around what was going to happen with the election, small caps, yield curve steepening. Most of that small cap move, though, Romaine, if you're honest about it, was all just PE expansion. Actually, the earnings estimates are decelerating still in small cap. So to me, if you use the Russell 2000 as your proxy, you can buy small caps, but you got to do it on valuation, which valuation means probably below 2,000, right? Above 2,000. Wow. there isn't just a really great risk-reward trade-off there.
What about, I mean, that's in aggregate. I mean, there's been a lot of talk about this as being a much more idiosyncratic market, the idea of stock pickers market here. Do you find value in any of the individual sectors in the small cap space or individual stocks?
I think it's probably more about individual stocks. You almost have to literally go name by name. As is well documented, 40% of the index itself still doesn't turn a profit, right? And from a cash flow standpoint, often have trouble even covering the interest expense on their balance sheets, which is a little concerning. I think as you get below the surface, though, I mean, S&P at 5,600 is consuming all the oxygen in the room right now. And it's giving a little bit of a false echo of what the overall element is looking like. When you get below the surface, the last 30 days, utilities have led, healthcare has led, staples have led, consumer discretionary continues to get killed on a relative basis and an absolute basis, right? So there's a lot of things, gold setting a new all-time high, right? The yield curve's about ready to uninvert. So I certainly understand less than 1% from S&P all-time highs, and that gets a lot of attention, but I think if you double-click below the surface, there's some trends there that you have to just give a little pause to.
Yeah, the ground is shifting even as the major indexes are still holding on to their recent gains. So you mentioned consumer spending. Let's go there when it comes to those consumer discretionary companies, because the retail sales number shows that people are spending, but the anecdotal that we get from the companies is pretty nuanced. People want value, and they're not just spending wherever they feel like it. They're spending very carefully.
Yeah, I think that's exactly right, Scarlett. You saw it in this morning's earnings, right? Target, obviously earlier with Walmart a few days ago, TJ Maxx, right? They're being discerning on where they're spending the money. I think it's this difference between, I'll call it lagging economic data, so to your point of retail sales, right, still showing decent, robust, and real-time corporate earnings. So when you look at the retail companies, they're telling you both for the second quarter closing out, but more importantly going forward in guidance, that they're concerned about the back half, right? They're concerned, Macy's CEO was saying, concerned about choppiness and what's going to happen. That is symbolic of the consumer overall, and it's showing up, we think, in stock prices, right? So we think you have to fade this consumer strength narrative and actually take the data and the real guidance for what it is in real time.
Okay, it's all going to come down to what Jay Powell says on Friday. He speaks at 10 a.m.
Yes.
So let's give it, 20 minutes? Do you see a situation where at 10:30 a.m. Eastern time, everyone's like, okay, that's it. We're going to pack it up for the weekend,
That's right.
Wait for NVIDIA, and then after that, no one does anything until after Labor Day?
Probably. I mean, I think the three big news events that are going to drive markets, barring some kind of aberration, is Jay Powell on Friday, NVIDIA next Wednesday, and then basically the September Fed meeting and what they do with interest rates ultimately, which is post-Labor Day, obviously. We were just talking about in strategy committee this morning. What happens if Jay Powell shows up on Friday and not intends to be hawkish, but is perceived hawkish, right? Because that's not where the consensus is. It's not where the base case is. We don't think that's likely, but if it does, it could roil markets pretty hard on Friday.
And it's more than just consensus. I mean, this is almost completely lopsided towards multiple, in terms of the pricing towards multiple.
It's asymmetrical
before the end of the year. I mean, when you look at the data and you talk to your economists and the other folks in your investment team here, and they look at that data themselves, are they seeing the justification for multiple rate cuts in short order?
Absolutely, but here's the difference. So I think the Fed should win in July, right? I think we're going to look back and discover that if they wanted to go deliberate and slow, which I think Chair Powell does, they should have started in July. They didn't have the data, right? Even the doves now, so think Kashkari, Bostic, Bowman are all turning, even more dovish and willing to kind of come in, basically, and cut rates. I just think you end up with this environment where what's mispriced today, if I look at the Fed funds futures, a year from right now, they've got 8 cuts in. Right? That's 200 basis points. So why then is the 2-year hovering around 4%? Right? If Fed funds is 5.25, the 2-year should be lower than that. Right, all else equal. So something's mispriced here again in the bond market.
I am curious, though, and I know you can't really get in mind of the Fed, but we just got the minutes from that July meeting. And while there was a lot of talk about potentially cutting rates, you can see or kind of feel the reticence that a lot of the members had about doing anything, not just at that July meeting, but even for the next meeting going forward. And I'm just curious, and I know that big employment report came after that July meeting, but it just raises a question what they are looking at that gives them the confidence to be so slow in moving lower.
I think they just want degrees of certainty, which is the mistake the Fed always makes, right? If you go back in past cycles in history, there's a famous quote that says, economic cycles don't die of old age, they're murdered, right? And the murder often is the Fed, right? Because they're too slow to react. They're waiting for assurance of the data. And I think that's, again, what we're seeing here. I think the world is slowing down a little faster than the Fed is reacting, and it may force them to not be slow and deliberate, but have to make a little more real-time adjustments in the back half of this year. Yeah, certainly puts a little bit more of the onus on that speech on Friday on Jay Powell to try to articulate some sort of strategy. Darrell, always a great conversation. Darrell Cronk kicking us off to the close, CIO of Wealth and Investments at Wells Fargo and Company and president of Wells Fargo Investment Institute. When we come back, we're going to dive deeper into those labor market revisions, an annual revision that is raising some new questions here about just how soft, Scarlett, the labor market really is.
And we are looking at shares of Ford. They are higher right now. Perhaps on relief, the automaker will delay part of its EV production plan. We're going to go into which vehicle it decided to scrap and why.
And we're also taking the temperature of the consumer. Two very different quarterly results that we got this morning, one from Target and one from Macy's. And you see the reaction there on your screen. All that and more coming up in a second. This is The Close on Bloomberg.
We're keeping an eye on shares of B. Riley Financial. They're up about 33% after being halted from trading for a volatility pause earlier. This on news, Oaktree Capital is nearing a deal to buy a majority stake in two of that company's businesses. With a deal expected to be announced as soon as next week, Bloomberg's Bailey Lipschultz is here now to break down what it could look like. So what part of B. Riley Financial is Oaktree really looking at here?
Yeah, so Bloomberg reporting that this would be on their appraisal and valuation services arm and their retail, wholesale, and industrial solutions unit, entities formerly known as Great American Group. This would be a small part of the company, which has kind of had its range of issues. As you mentioned, the stock up more than 30%, still down 80% in the last 12 months, given an SEC investigation, potentially concerns around their debt, which is about $7 billion in the next few years, as well as just kind of general uncertainty around the company and being able to catch up on a number of overdue filings.
In addition, I mean, we talk about the uncertainty around this company, but when you look at the businesses, at least that Bloomberg is reporting that Oaktree is interested in, there's some viability there, right? I mean, the idea here is what's going on with B. Riley is much more about the people who are in charge rather than the actual businesses themselves.
Exactly. And the folks at Oaktree are very smart. So seemingly they would not be kind of kicking the tires on acquiring units if there wasn't value there. And as Scarlett mentioned, about $380 million in the deal on the two units is relatively small compared to the likes of kind of assets that an Oaktree would be pursuing.
And very quickly, you mentioned they have a lot of debt. That debt actually was retail investors are exposed to a lot of that debt.
Yeah, they sold a lot of so-called baby bonds in the increments of about $25 to individual investors. Those are unsecured obligations. So were something to happen, those investors would not be first in line like typically safer loans that are kind of...
They kind of become equity investors in a way.
In a way, yeah,
All
exactly.
Right. Bloomberg's Bailey Lipschultz, thank you so much. And of course, we're looking at B. Riley Financial higher today by about 30%. But again, it's had a long decline. This is a fascinating story precisely because so much of it has to do with the people in charge and less with the business itself. Yeah,
we do want to turn our attention right now to what's going on in the world of politics. Of course, the Democratic National Convention, Scarlett, is still taking place in Chicago. And of course, the big marquee events are supposed to be tonight, where we're going to hear from the vice presidential nominee, Tim Walz, and then, of course, tomorrow night, where we hear from the presidential nominee, Kamala Harris.
Yeah, but yesterday was a marquee event if you listen to Michelle Obama. Yeah. She was a star.
Was she? I didn't listen to it.
Yeah.
Did she sing? What did she do? Yeah.
She got everyone chanting.
All right. We do want to go out to Chicago, where our very own Joe Matthew and Kaylee Lyons are on the ground as the New York contingent of the Democratic Party arrives for their delegate conference.
Thank you, and a pleasure to welcome Bloomberg's global TV and radio audiences here to Chicago, Illinois, indeed the site of the Democratic National Convention now in day 3. I'm Joe Matthew alongside Kaylee Lyons and a special guest as Democrats are still trickling into Chicago. One of them is the mayor of New York City, Eric Adams, joining us here at the table on our set in Chicago. Mr. Mayor, welcome. It's good to see you.
Thank you very much. Great to be here.
Well, you're joining the party here as to something that's been a pretty energetic rally so far in Chicago. And we've heard from New York's governor. We heard from Congresswoman Alexandria Ocasio-Cortez. How come the mayor of the world's biggest city isn't speaking tonight?
Well, you have a real focus, and I think this campaign is doing something that's extremely smart. We feel strong in New York. We have very few other areas that we need to focus on. And the goal is not to get Eric Adams on the stage. The goal is to get VP Harris and the team elected. And they're putting together the right speakers, and we're just going to find out what is our role, and we're going to carry the ball based on that.
So you may not be a messenger on the stage at this convention, but that doesn't mean necessarily that there might not be a message you would advocate for, not just given your role as mayor of New York City at a time when Republicans are criticizing cities, including where we are now, Chicago, on issues like crime. But you're a mayor and a former cop. What is the winning message on crime for a former prosecutor as she campaigns for president of the United States?
And I think that's an amazing question, because this is what I've been talking about for so long. We have a great product in the Democratic Party. We're leading the voice around getting rid of assault rifles, about being proactive and not placing people on pathway of criminality. And we need to sell that. And unfortunately, we've allowed the belief that Democrats are soft on crime, and we're not. Crime is dropping in New York City and many of the cities where our mayors are located. I was speaking with the Atlanta mayor a few days ago. We're seeing a real focus on public safety. I say it all the time. It's the prerequisite to prosperity. And that's the leading message coming out. Affordability, public safety is crucial to this election.
We spoke earlier with the mayor of San Francisco, which has been held up as the poster child for crime in this country by Republicans criticizing progressive policies when it comes to crime and safety. Chicago, where we are now, he compares to Afghanistan. Donald Trump refers to New York City as a war zone. You're talking about crime statistics. Do you start putting up billboards? How do you get the facts delivered?
Oh, it's so important. And, one thing is when someone used an analogy of saying things are out of control in New York City, our subway system with 4.1 million riders, we have an average of 5 felonies a day. We want to get rid of them, but let's put it in perspective. Our robberies are at the lowest record in recorded history. And when you look at all the major crime categories are decreasing, our economy has come back. New York City is a real model of how a Democrat can turn around the city and move it in the right direction.
Well, of course, we don't just pay attention for New York City and the way in which crime is being handled, but migration also, considering you have had an influx of migrants that the city have had to deal with. You've actually been somewhat critical of this administration in that regard. Kamala Harris is part of this administration. She was charged in the early days with taking care of the issue of the border. This is something Republicans are placing a lot of blame specifically on her for. Does she deserve some of that blame? Has she not played a role in what has happened in New York City?
Well, first of all, we received over 212,000 migrants and asylum seekers, and I'm proud that not one child or family is sleeping on the streets of the city of New York as we manage that. And I've been extremely clear about securing our borders. And I think that when we look at blame to be placed, it's the lack of real, true immigration reform. This is a country where immigrants have always participated in the American dream, and we need to ensure that we have a pathway in doing so. And I'm looking forward to sharing my ideas with the administration on some of the things we witnessed in New York, and as national immigrant leaders have looked at what we have done in a level of humanity that we've shown. The key here is employment. You put people to work, they can pursue the American dream. If you don't, we take away that dignity.
Mr. Mayor, federal prosecutors in New York served another round of grand jury subpoenas, this time directly to you in a corruption investigation that's been going on for the better part of a year now. You've made it clear that you're done talking about this, that you want the process to play out. Don't the people of New York deserve a little bit more of an explanation than that?
What the people of New York deserve is a very thorough review, and I feel confident when that review is done, they're going to see that I did nothing wrong. Former law enforcement officer, I know what it is to ensure that laws are enforced. You don't break them. And then it's important that the people of New York have a mayor that's disciplined and focused. My job is to fight on behalf of New Yorkers, bringing back the economy like we have, making sure our streets are safe like we have, build affordable housing like we are doing. That is my focus, and not to be distracted. Let the reviewers do their job. I'm going to do the job that the people elected me for, and that's to recover our city.
Well, Mr. Mayor, when Donald Trump was getting hit with all of these different indictments, some of the way in which Democrats were prosecuting the campaign against him was that he's too mired down in legal battles and he is distracted. And that's a lot to deal with, even personally, let alone trying to be a leader. How are you navigating that personally? Why should New Yorkers not have doubt about your ability to do all these things at once?
Well, I think that, as you indicated, this was going on for several months. And look where our city is. You have a mayor that managed 212,000 migrants and asylum seekers. The economy has been revitalized, more jobs in the city history. Our subway systems are safe, 17,000 illegal guns removed off our streets. Our children are outpacing the state in reading and math. When you do an analysis of what I've done from tourism to safety to productivity to housing, you have to say to yourself, darn, that guy don't get distracted. He knows how to run a city, just as I was a person that knew how to keep the city safe as a police officer.
All right, Mr. Mayor, thank you so much for making time to us in the city of Chicago, not in your hometown today here on Bloomberg TV and radio. We appreciate it. That is the New York Mayor, Eric Adams, and we'll send it back to you.
Thank you, Kelly. And that's, by the way, it's the greatest city in the world, Chicago, just to put a finer point on it. Our thanks there to Eric Adams, of course, the New York City mayor, as that New York delegation arrives on the ground for the delegate votes tonight. Of course, we'll check back in a little bit later with Kaylee and Joe with their full coverage of the DNC convention continuing. We do want to turn back to the markets here on the close with just about 40 minutes until those closing bells. And one of the big movers on the day is Ford. The company actually admitting that their electric vehicles aren't seeing the supercharged sales that they had previously bet on. The automaker now pivoting away from the EV strategy to focus on hybrids and other affordable options. David Whiston is Morningstar's equity strategist covering U.S. autos, and he joins us, well, from where else? The beautiful city of Chicago. All right, David, let's get right to it. I mean, this probably isn't a total surprise here, given some of the broader industry trends we've seen in EV adoption. But Ford was also pretty aggressive about leaning into the space with the Lightning, with the Mach-E, with some of its other offerings here. Is this a pullback in that strategy or simply a rethinking?
I think it's more pivoting to focusing on what they do best in terms of where the EV is going to go. That's why you see the three-row SUV going away and focus, and the EVs will continue in full-size pickup trucks, the mid-size pickup truck, and commercial vans, all of which they do really well. To your point, though, it's interesting because Ford, yes, they were first with an electric full-size pickup truck with the Lightning and whatnot, but they did take a shortcut. They made that onto a combustion platform, whereas GM was later because they built all new EV platforms for the Silverado and Sierra and the Hummer SUV and Hummer pickup truck. So they took a bit longer.
Yeah.
It's, I mean, Ford was initially, to remember, focused on hybrids under Mark Fields, and then they went to EVs, and now they're pivoting again. Probably trying to get costs under control because that segment's going to lose over $5 billion this year.
So, David, part of that pivot also includes building out these extended range EVs, right? These SUVs. Can you talk a little bit about how they're going to make that happen when they can't make the three-row SUV profitable?
Well, I think they're just going to, from the EV side, they're just going to focus more on trucks for now and do hybrids and combustion for the SUVs, and then probably come back to SUVs in an all-electric sense after 2027.
Well, David, I am curious, though. Just let's focus on the cost side of this, because when I hear all these kind of flip-flops going from one strategy back to another, that doesn't sound cheap to me, right? We're talking about major changes that I guess long-term might save them money, but in the short term, this has got to add a little bit here to some of the expenses we're going to see in the next earnings reports.
Yeah, they talked in the press release today. They talked about a $400 million special charge, and then up to $1.5 billion in future cash, effectively write-offs for the investments they've made in the three-row SUV that they're going to discontinue. Unfortunately, I think you have to look at it as a sunk cost. I mean, in hindsight, you'd say, well, maybe you shouldn't have pursued it in the first place. But they made a decision after research and investing that they can't make money on this vehicle. So even though it hurts to have these write-offs, I'd rather they hit the brakes on it now than keep investing, even though they know they can't see a path to profitability.
Right.
You don't want to make it a loss leader and turn that $1.5 billion into $3-4 billion.
Yeah, investors won't take kindly to that. David, really appreciate your joining us. David Whiston, of course, with Morningstar. Now, coming up on the close, all eyes are on Jackson Hole, where Fed Chair Jay Powell may signal a September rate cut. BNP Paribas senior U.S. economist Yelena Shulyatyeva will tell us what she'll be listening for when he speaks on Friday at 10 a.m. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Scarlett Fu. Where were you this morning at 10 a.m.?
At 10 a.m., I'm not quite sure where I was. I was probably getting, my typical morning, drink, which is, half syrup, half milk with a splash of coffee in it.
You're such a slacker.
Yeah, with a little whipped cream on top.
I know you don't start to show up for work until
No, what was happening at 10 a.m.? Was there something supposed to be going on?
There was supposed to be something happening at 10 a.m., except everyone waited around. Everyone was glued to their terminal, and nothing came through. Everyone was waiting for the revision to the payrolls number from the BLS.
Oh, these are the revisions that Tim was boring me with yesterday.
Yes.
So was it like, did I miss something?
It finally came at 10:30 a.m., and it was a big revision downward.
And these are like the annual revisions that the government does.
Yes, it happens every year.
So this is routine. But this one was supposedly a bigger deal than past years.
Well, yeah, because everyone's so extra sensitive about, where the labor market is at and whether we might have missed a sudden weakening in the labor market and not have accounted for it. And really, Friday marks the next chapter in the central bank's inflation battle when Fed Chair Jay Powell is expected to signal a September rate cut. It's really a chance for him to craft remarks around developments that have taken place after the July FOMC. That includes soft payroll numbers for July, cooling CPI, and, of course, all the market volatility that we saw that peaked in early August. For more on this, let's bring in BNP Paribas senior U.S. economist Yelena Shulyatyeva to give us a little bit more here. So, Yelena, it's all about expectations. And there were some expectations that we would get a downward revision of 1 million jobs. Instead, we got 818,000. So this was, how would you characterize this revision?
I mean, there was a wide range of expectations, and some people, including us, expected a slightly less of a downward revision. It's really about what you make of this number as it applies to the forward trajectory of payrolls. It's not really about what happened in the past. It could be revised even further, to the upside included. So I think what is worrying here in that revision is that maybe there's this kind of an error in the numbers that we will see included in the payrolls numbers going forward. So that's a risk here, right? So we still see decent payroll growth, but maybe it's not as good as the numbers are telling us. But having said that, if you look at the economy continues to grow. Yeah. We still get decent numbers on economic growth, consumption, and the signals from companies are that the consumers continue to spend. So I think that all in all, this is just telling us that, very strong, robust numbers that we saw last year were not as strong. Right. And we were all surprised when we were getting them anyway. So it gets the household survey with the establishment survey closer, and that's what I make out of it.
So the trajectory is not all that different, even if the numbers and the scale of the gains that we saw might be revised lower here. What does this mean in terms of how you're thinking about the August payrolls number? Right now, the consensus estimate is for 155,000 jobs. Are you revising that down based on what you saw with this revision?
Absolutely no impact on our projections for August payrolls. We think that we're going to see a rebound. We still think that despite what BLS said in the report that there was no impact from the weather, there was some impact from the weather in that July report. So we may see some rebound here in August. But nonetheless, I think job growth is slowing regardless of what we saw in the revisions. You can see that in the more recent data, like jolts and openings and things like that. Yeah. But there are no layoffs to a big extent because claims are still pretty low.
But even if people aren't necessarily losing their jobs, Yelena, and I'm sure you know this as obviously being a much smarter on economics than me and Scarlett, is that it has sort of a psychological effect on a lot of folks. Those who are still employed, they're not going to spend the same. And there were a bunch of retailer earnings that came out this morning, and they all, while the reports were sort of different in nature, the common thread was that people are searching for value. They are much more budget conscious. I interviewed the CEO of Macy's earlier this morning, Tony Spring, and he really hit home with this idea here that basically they are seeing a customer that is much more discerning, and now they are retrenching the company itself to trying to find ways to accommodate this. And he sees a really rocky next few months ahead. And I'm just wondering, when you're hearing these type of comments out of the companies, even though it hasn't shown up in the official data, should we be worried?
We should be cautious and obviously watch the data very closely. I don't think that we are going to see a deterioration. We definitely are seeing some slowing, moderation, and the comments basically confirm that narrative. I think it's really about the different types of consumers, right? High-end income consumers are still spending. We still have this massive deleveraging that happened since the Great Recession. People can borrow, and they can borrow pretty easily if you have good credit and high income. And the wealth effect is still present. Look at home prices, look at equity markets. Mm-hmm. I think that kind of buffer will help us in terms of consumer spending, even though a large group of consumers is probably struggling indeed with high prices.
Well, that gets to a tricky question here about what the Fed should be reacting to. So, because you're kind of describing a little bit of a tale of two cities here. Should the Fed's reaction function be on those aggregate numbers, basically just looking at the totality and then shifting rates accordingly? Or should they look at that bifurcation and then make adjustments based on that?
Well, that's why there are a lot of smart people who work at the Fed. And basically, yes, the mandate is unfortunately pretty blunt, right? You have to react to overall the totality of data. And that's why we expect them to start cutting rates in September. So they're ready. The minutes from the previous meeting told us that they were ready to start the cutting cycle, but the cutting cycle will be to reduce that unnecessary restriction in the economy, not trying to catch up falling knife.
Yelena, very quickly, I mentioned earlier on that these revisions were supposed to be released at 10 a.m. They weren't. It took about a half hour more, but you managed to get a hold of the numbers a little bit earlier than a lot of people did. What happened there?
So we were just thinking maybe there's some technical glitches you mentioned. So we just called the public line and we were given the numbers. And that seems like that's the whole story. So
she picked up the phone.
Yelena, well, that's like real on the ground shoe leather reporting. Yelena, always great insights, and we always love talking to you. BNP Paribas senior U.S. economist there. A closer look here at those payroll revisions, a closer look at the health of the consumer, topic that we're going to dive a little bit deeper on when we come back after the break. It's our stocks of the hour, and we're taking a look at two big ones moving in opposite directions, Macy's and Target. We'll be back. This is the Bloomberg. All right, apologies to Charles Dickens, but it was the worst of times and the best of the times for two of the largest retailers in the country. Shares of Macy's and Target moving in opposite directions after posting quarterly results. And there was one common thread between them, and that is shoppers are much more price conscious. Now, Target had actually cut its prices, which helped to boost its bottom line. You see the shares having its best day going back to March. Macy's, though, a little slow on the draw. Its shares moving lower by the most in about a year. Jeanette Newman, who covers the department stores for us here at Bloomberg, joining us right now to talk a little bit more about this. And let's start off with Macy's, because this is a much bigger story. They've got a new CEO who just started this year, a big turnaround plan that he's been trying to execute, and he's now trying to do that in the face of what is clearly, let's just call it, a somewhat softer consumer.
Hi, Romaine. Thanks for having me. Yeah, he's up against some tough times, and because Macy's hasn't been able to deliver on revenue, Tony Spring, the new CEO, as you said, who started in February, he's focusing on what he can control maybe a little bit better, which is profitability. So you did see Macy's in the prior quarter that ended in May, and this most recent quarter, you did see them beat on profit. And they, maintain their outlook for EPS for the remainder of the year, even as they cut their revenue outlook for the remainder of the year because of, as you said, a more cautious consumer and more discounting from competitors. Now, Macy's didn't name those competitors that are discounting, but as you said, one of those competitors was Target, right? Target was able to attract a lot more shoppers in the most recent quarter, in part because it cut prices.
Right. And that's an important distinction to make here because Target can cut prices on a lot of its own private label brands. I know Bloomingdale's and Macy's do have their private label brands, but they are kind of an emporium for other people's products. So how much pricing control does someone like Tony Spring have over the products that they do sell?
That's a great point. They don't have as much pricing control. And Tony Spring mentioned when we spoke to him that they are cutting prices on some products where they're seeing particularly stiff competition, for example, with home goods. And you've seen other retailers such as Home Depot and Lowe's call out some of the lower demand there, and so price pressures on those items. But also to a certain extent, I mean, especially at Bloomingdale's and also at Macy's, Tony Spring doesn't want to cut prices too much. That's not the image that Macy's wants to give of just, a discount shopping place. It's trying to, maintain some of those price gains that it made during the pandemic, which of course is helping profitability.
But how do you do that, Jeanette? Because he also talked about in that interview the idea that this is kind of an industry-wide phenomenon, meaning the promotional nature that we're seeing in the consumer space here. So to be the outlier, to try to buck that trend, you got to really offer something else of value.
That's definitely true, and I think that's the challenge that they're facing. Part of what Tony Spring is trying to do with this turnaround plan that he's put in place, that is a 3-year plan. So we're kind of only 2 innings, 2 quarters in. But one of the things that he is trying to do is make it more attractive to shop at Macy's and to buy at Macy's. So he's focusing his efforts on the 50 top performing Macy's stores across the country. One of the things, for example, that he's done is hire more staff in the departments that sell shoes and handbags, and also have better merchandise. And that's actually worked really well. Sales there have gone up, and so he's decided to roll that out across 100 other stores.
All right, Jeanette, really appreciate your joining us with the details from your conversation with Tony Spring. Bloomberg's Jeanette Newman.
Some breaking news coming in right now, Scarlett, on Apple. Apple's longtime App Store head stepping down in a reorganization. This is Mark Fisher, who has actually run the App Store since at least 2010. According to people familiar with the matter that Bloomberg spoke to, he will be leaving Apple in October. Basically, the overall reason that they're giving here, Scarlett, is really just some sort of reorganization to sort of make the App Store and some of its payment methods, I guess, a little bit more aligned here. Not quite sure why he couldn't do that, but Phil Schiller, who is ultimately responsible for it, is making those changes.
Yeah, perhaps in part due to some of the scrutiny from regulators as well. Coming up, Jay Woods, Chief Global Strategist at Freedom Capital Markets, will be joining us as we count you down to the close. This is Bloomberg. All right, breaking news crossing the wire. Matt Fisher, who has run the App Store business since 2010, is now leaving Apple, according to people familiar with the matter. Bloomberg's Mark Gurman got the scoop, and he joins us now. So, Mark, Apple is reorganizing its App Store. Give us a little more context here.
Yes, that's right. Matt Fisher, he's the vice president in charge of the App Store business and Apple Arcade. Obviously, the App Store generates somewhere north of $20 billion per year for Apple. It's one of their remaining key growth areas as part of that services organization. He's leaving the company in October. This is a major development. This is coming as part of a company reorganization right within the App Store group. The App Store group has been under scrutiny from global regulators for a couple of years now. As we've discussed in the past, global regulators such as in the EU, some in the United States, some in Australia, are looking for Apple to allow alternative versions to the App Store so developers can bypass Apple's payment methods. Yeah. This has been very much at the core of what the EU is doing So now the App Store team is splitting into two, one related to the in-house App Store and one related and responsible for alternative app distribution. Apple is doing this to help continue to grow the App Store and to really be able to respond more quickly to these global changes.
So who's running things right now, Mark, and is that going to change?
Well, Phil Schiller, he's ultimately responsible for the App Store. He is one of Apple's longest-serving executives. He really was very key in returning Apple to being Apple in the late 1990s alongside Steve Jobs. He's one of Tim Cook's closest lieutenants, a direct report to Cook. So he's ultimately responsible for that App Store business in addition to a couple of other things. Matt Fisher was the person who ran the App Store business reporting to Schiller, so he's leaving. He's going to be replaced by two of his lieutenants. One is named Carson Oliver. He's a longtime senior director related to the actual nitty-gritty of the business. The other is Ann Tai. She's been a director in charge of App Store product features. And so the two of them will now report to Schiller and lead that combined new App Store group.
All right, Mark Gurman, really appreciate your breaking the news for us. Bloomberg's Mark Gurman, and of course, Apple shares fell to their session lows on this headline, but have since recovered just a bit.
All right, the broader market still holding on to gains here on the day. Let's get right to it. Jay Woods, Chief Global Strategist over at Freedom Capital Markets, helping us count you down to those closing bells. And Jay, we got a Fed meeting, I think, next month or mid-September. That last Fed meeting at the end of July, we just got the minutes from that today. And of course, that was 2 days before that big blowout jobs report here. Probably the most intriguing thing, though, about those minutes was there was a meaningful discussion about whether they should cut rates and, more importantly, whether they should have done it then and now.
The market had a little spike on that news. It looked like there was a 50-50 coin flip that they could have actually cut at the last meeting. And when we found out that unemployment number, they were focused on inflation, even though their statement said we're the dual mandate will talk about unemployment. They could have done it, and they didn't. And the market told them, you kind of messed up. So it's interesting to see where they're going now.
Well, they've got another big chance to kind of telegraph where they're going prior to that meeting. And of course, Jay Powell speaks on Friday at Jackson Hole. What, as an investor, do you want to hear from him?
Oh, well, as an investor, you want to hear we're going to cut 50 basis points, and this is the beginning of a great cutting cycle. But I think you use the word telegraph, and that's what Jay Powell does better than anyone. He telegraphs all these things. These minutes were telegraphed to say, yes, we're going to cut 1/4 point, and probably at this meeting in September. I think he's going to probably just verify that fact at Jackson Hole. He doesn't like to surprise us. We did have a little panic on August 5th when the VIX spiked over 60 and people were talking emergency rate cut. I talked about it here with Manis, and I thought that would have been foolish at the time. The market has told us, we're not there right now. So since we've had some time to digest what happened on August 5th, the market's telling us, okay, we believe that this cut is coming. Now, is it 25 basis points or 50 basis points? Maybe we'll find out tomorrow or Friday on Jackson Hole.
Manis Craney, he's quite a character, by the way.
He's the best. He's the best. So.
You mentioned the VIX and how it got to 65 on August 5th. It didn't stay there. And of course, in the days since, it's reached below 15. It's now around about 16.3. Where should it be? I mean, how reliable of a gauge is this to you?
Well, it's crazy. I've been doing this a long time. That's the third highest reading in the VIX ever. It's higher than 9/11, which blows my mind living through that. But what we've seen in spikes in the VIX, and I went back and I looked at election years, 2016, 2020, we had spikes in the VIX, 2020, obviously COVID, but in September and right before Election Day, October, early November, we've seen another spike. So there are going to be headlines that rattle this market. There's still geopolitical concerns. We don't know if there's a second leg to drop with this yen carry trade. It didn't resolve itself in a day, but all of a sudden we forgot about it. And this recent rally is historic. It's a buy the rumor, sell the news, and I'm concerned that we may have a near-term double top in this market, and we could sell the news after Jackson Hole, unless Powell does something remarkable, which I don't think he will do.
Yeah, we're awfully close to matching the record high in the S&P 500. You mentioned the yen and how the yen carry trade blew up until it didn't. What do you look at? Which asset prices do you look at when you wake up in the morning?
Well, I try to look at everything, but, as an equity trader, we're watching the dollar, and the dollar is stabilized now. And, we're back to where we were on August 5th. It's like it almost never happened. But to me, what we're watching now is just Fed speak, and more Fed speak.
Yeah.
We got through earnings season, and NVIDIA obviously is going to be what all we talk about next week.
Yeah.
And we'll see what that does to the overall market. But right now, it seems like we've come a little too far, too fast in the other way. And given seasonal headwinds, which I strongly believe in, August, September, the last 3 August, Septembers, we've been lower. This August, we're slightly up, still have a week to go. I think we're going to chop for a little while. So to get the momentum to continue after what we saw on August 5th, I expect some choppiness. I expect a couple spikes in the VIX over the next 4 to 6 weeks as we head into the election. And then after the election, what we know is it's the strongest time of the year, and I think we'll finish the year strong. And those small caps finally, which I've been touting for too long, will finally catch a bid as well.
Are you buying anything right now?
Well, it's funny you say that. Election-wise, there are 2 sectors I like. I like the defense sector, and I like cybersecurity. I know cybersecurity's been in play because CrowdStrike had, their little situation. But the cyber stocks, when you look under the hood, you look at the 2 ETFs, CIBR and HACK, they're both at or making new all-time highs. As a technician, I like the strength there. Then you look under the hood. What are the stocks leading that sector? Palo Alto blew it out. They're doing well. CrowdStrike's holding us back. They got a nice upgrade from JP Morgan. It may take them some time, but I look at stocks like Checkpoint, Fortinet, and then Cisco. Here's a stock I can't believe I'm. Yeah, thank you. That was my reaction too. And I looked at the chart. It broke a near-term downtrend. The deal with Splunk is finally 6 months in. That was a big deal when it happened. You're looking for them to go into the cyberspace. Splunk was a great acquisition. I think that it's going to finally pay dividends, but if you look back 20 years, you own Cisco, and I did for a little while. It really hasn't gone anywhere. Will this be the time? I don't know, but over the near term, it looks like it's got a tailwind, so I like it over the next few months.
All right. Well, Cisco has certainly been back in favor with a lot of folks. Jay Wood's always in favor with us, one of the best in the business, chief global strategist at Freedom Capital Markets. As we march to those closing bells, just a little more than 2 minutes away here, with stocks right now right around session highs. Big outperformance by the Russell 2000. A full breakdown coming up now, right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu, taking you through the closing bell. It's a global simulcast. It starts right now with Tim Stanovic joining us in the radio booth, Alex Steele taking a much-deserved day off, and Carol Masser, who I think has been off for the last 2 weeks, finally making a return. Great to see you, Carol Masser. You look tan, rested, and ready.
I don't know about that. I guess what I am, though, waiting, and I do feel like this whole week is about what we get out of Jackson Hole, most specifically what we get from Jay Powell at the end of the week. So I feel like, I know we saw rates move a little bit lower today, but I feel like that's what we're all waiting for.
Obviously important what we hear from Jay Powell, but really I think what investors are thinking about is what that September meeting looks like. Do we get a rate cut? And I guess they got some more evidence that potentially we will see a rate cut, given that the Federal Reserve minutes came out. We saw those, the downward revision of U.S. payrolls. So it looks like more and more evidence that a rate cut is on the table.
Yeah, we're marking time until Jay Powell says those magic words, anticipating that rate cut in September, whether it's 25 basis points or 50 basis points. And then after that, NVIDIA is going to obsess it's going to obsess us. It's going to dominate all of our attention because this is the poster child for all the AI hype.
Yeah, and it kind of concludes the earnings season more or less here. Of course, we had a lot of retail earnings this week. Obviously, NVIDIA last week. And then for some reason, Tim, you made me sit at my desk at 10 a.m. this morning for something that apparently never came.
Yeah, well, it came at about 10:30.
Okay, well, I got to use the bathroom.
I was waiting for that, too. Yeah. We don't know yet what happened, but we know it was delayed.
Aren't you just a good little business journalist, just sitting by waiting for that to cross?
All right, well, we get the closing bells here in New York. A bit of a turnaround from what we saw yesterday. Volume still light, but again, the sentiment and more importantly, the momentum remains to the upside. The Dow Jones Industrial Average up about 55 points or about 0.1%. The S&P 500 is going to close higher by about 24 points, right around that 56.21 mark as we wait for these numbers to settle. Remember, 56.67 and change is the last record high, a 0.4% gain on the day. The NASDAQ gaining about 0.6%. And take a look at the Russell 2000. Not only up about 1.3%, Carol, but that should, if my math is correct, going to be the best outperformance we've seen on the Russell versus the S&P all month long.
Yeah, pretty significant to see that stand out. I'm going to go back to the big caps, if I may. The S&P 500, most names, guys, higher today. 402 to the upside, Scarlett, and 100 losing ground, 1 unchanged.
Yeah, that's quite a ratio, that 4-to-1 ratio. All right, let's take a look at how the sector performances shape up when you split the S&P 500 into 11 groups. 2 are somewhat in the red, and I say somewhat because energy is little changed right now. Financials down ever so slightly because of Franklin Resources and American Express. On the upside, you have consumer discretionary due to a strange mix of retailers, which we can get into later on, materials and utilities. So some of those defensive names are doing better. Utilities and consumer staples, the third and fourth best performing groups today.
As you guys know, a lot about retail today. We heard from a lot in the sector. So let's get to it. Target, number 2 gainer in the S&P 500, folks, up almost 16% at its highs, finishing the day with a 10% gain. The company ending a string of sales declines in the second quarter. The retailer also coming out reporting comparable sales, and adjusted EPS for the second quarter that topped analyst expectations. They've been struggling, but they certainly delivered today, and investors noticed. Another one, TJX Companies. This, of course, home to TJ Maxx, Home Goods, and others. This one finishing up with a more than 6% gain, hitting a record high. I think it may have closed at a record as well. Let me just pull it up here. And as we do, closed at a record, increasing its full-year projections for comp sales and profit following second quarter results that did top. Analysts encouraged by the outlook boost, and the CEO's comment that the third quarter is off to a strong start. The other thing, layer this on top of it, the company, TJ Maxx, acquiring a 35% stake in Dubai-based brands for less, so they continue to take their model and really pushing it out globally. And one more, not retail, but in the housing sector, Toll Brothers up about 5.6%. The home builder announced third quarter earnings late yesterday, forecast diluted earnings per share for the full year that beat the average analyst estimate. So investors again noticing that one, sending it a lot higher, really outperformance in those names, Tim.
Okay, a couple retailers and a home builder for you. I got a retailer at the top of my list for decliners. Look no further than Macy's, down more than 12%, close to 13%. This after the company cut its net sales guidance for the full year. It cited a more discriminating consumer, heightened promotional environment. Mary Ross Gilbert reminded us that Macy's is always doing these promotions, but it's facing competition now from specialty apparel, off-price retailers like TJ Maxx, even online outlets these days like Shein. She also talked about that specific customer segment getting squeezed. She's over there at Bloomberg Intelligence. And then Scarlett, you heard mention Franklin Resources, ticker BEN. Ben, it's the on a percentage basis, the worst performing stock in the S&P 500. It is the parent company of Western Asset Management. Shares falling the most since 2020, down more than 12% today. This after Western Asset Management said Ken Leach is on a leave of absence effective immediately. Leach faces a potential enforcement action from the SEC as part of a probe into whether some clients were favored over others in allocating gains and losses from derivatives trades. Just in the last hour, our team at Bloomberg News reported that federal prosecutors in New York are investigating whether a Western Asset Management executive allocated winning trades to favored accounts as part of a criminal probe into a practice known as, quote, cherry picking. And then finally, ADRs of JD.com falling today by more than 4%. This after Walmart sold its stake in JD, raising about $3.6 billion. Romaine, that stake sale marks the end of a partnership that started back in 2016. Walmart's still trying to figure out how it fits into the Chinese economy.
Yeah, let's take a look at yields here because that's where we saw some of the big moves here on the day. Treasury prices did push higher on the day, pushing yields lower about 5 basis points on the short end of the curve. More modest declines in yields on the longer end of the curve here. And of course, with that buying that we saw in the Treasury space, it started earlier in the session. Of course, it accelerated after those jobs numbers revisions mid-morning and then accelerated further when we got the Fed minutes around 2 p.m. Eastern time here, Carol and Tim.
All right, so let's get to some stories that caught our attention on this Wednesday. And this one has to do with what Americans think, what number, if you will, says that you are basically wealthy in 2024. And so Americans on average believe it takes a net worth of about $2.5 million to be considered wealthy this year. And that is a 14% jump from last year. This is according to Charles Schwab, their Modern Wealth Survey.
All right, let me just interrupt you for a moment here because Snowflake earnings just came out. And for the quarter that ended, second quarter revenue did beat analyst estimates, $868 850.8 million versus an expected 850.7 million. In terms of the outlook for the third quarter, it sees product revenue of 850 to 855 million. That is higher than the average analyst estimate of sub 850 million. And it also sees a third quarter adjusted operating margin of 3%. The second quarter adjusted EPS also beat analyst estimates, but the stock is down about 7%.
Zoom also out with its results. This is Zoom Video, ticker ZM. Revenue in the most recent quarter coming in a touch above Wall Street estimates, $1.16 billion. Adjusted EPS of $1.39, beating Street estimates of about $1.22. The company, here's your revenue guidance for the year. The company says $4.63 billion to $4.64. That's above its previous estimate that it got, and the lower end of that range is above the consensus on Wall Street. Those shares higher by 3% in after-hours trading.
All right, also popping in the aftermarket, shares of Urban Outfitters. Let's get to some of the numbers. Second quarter comp retail sales segment up 2% versus an estimate of 2.94, so that's light on that one. Second quarter Urban Outfitters segment comp sales down 9.3%. The estimate on the street was for a decline of a little bit less than that, 8.75% to the downside. And second quarter EPS of $1.24 a share, but you're seeing the stock up about 2.6% here in the aftermarket. So we'll look for some more in terms of some of the numbers there.
Okay, speaking of more, we're getting more earnings. Synopsys boosts its fiscal year adjusted earnings per share forecast. It beat estimates. The guidance beat the average analyst estimates. Sees adjusted EPS for $13.07 a share to $13.12. Beating estimates of $12.90 to $12.98. Shares not really going anywhere in the after hours.
Well, one of its competitors are seeing its shares down significantly. Wolfspeed down about 8% right now. Of course, this is the maker of semiconductor parts here. The company reporting an adjusted loss per share of about 89 cents. I'm not quite sure what the comparison is with street estimates, but you see the reaction there in the shares here. Revenue also coming in, looks like a little bit light at around $200 million for the quarter. The company also saying, though, that it is targeting a revenue range for the full year, for the first fiscal quarter of the new year of 185 to 215 million.
Kind of rough. I mean, this is a name, it's about a nearly $1.7 billion market cap making of semiconductor products. But I mean, Wolfspeed's been down about 70% year to date. So now you're looking at what, Scarlett, another 12% drop here.
Yeah, pretty painful. And of course, this is all kind of at the very end, the tail end of earnings season, which for the most part has been decent, except for those companies that have a lot of exposure to the consumer, which we've been seeing from the likes of Target, the likes of Macy's.
What was your favorite earnings so far this year?
My favorite earnings.
Oh, it's so hard to choose, Romaine. We can't play favorites here. You know that.
We love them all equally.
That's
right?
All of them.
Wonderful. We love them all. And now we're almost at another one, another earnings season.
Do you know what Tim said about you while you were gone, Carol?
I don't know what I said about her.
Stop causing problems. No. All right.
Of course she knows because she was listening and watching nonstop when she was out. What else? Yeah. How else do you spend vacation?
That was it. I love you guys, but that wasn't.
No, not true.
All right, that's a wrap. Our cross-platform radio, TV, YouTube, Bloomberg Originals. We will see you again, same time, same place tomorrow, everybody.
And we continue our coverage right here on Bloomberg Television. A deeper dive into those earnings just crossing the wire. Lindsey Bell, Chief Investment Strategist over at 248 Ventures. She's stopping by the big program next. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. A market rebounding pretty significantly here on the day. The S&P 500 adding to the gains as it tries to march back to that all-time high. You saw similar moves in the Dow, similar moves in the NASDAQ, but the outperformer on the day was the Russell 2000, up more than 1% here on the day. And of course, some of the rate-sensitive sectors also getting a bid as we saw a drop on the shorter end of the curve. the XHB Home Builders ETF up 3% on the day.
You mentioned how stocks rose overall and small caps kind of led the way. The Dow was the laggard here, and the big reason why was American Express, the worst performer in that measure after Bank of America cut the rating to neutral on muted spending, says it sees limited incremental upside given the stock's premium valuation. Just to keep in mind, American Express is still up about 31% so far this year. But I wanted to focus on the consumer and retailers overall because Target finishing the day up 10%, all those price cuts clearly paying off, winning over price-conscious consumers that allowed it to end a string of quarterly sales declines. Different story over at Macy's, where consumers clearly are not spending as much in department stores. Macy's missing on the quarterly revenue and also reduced its full-year outlook. Increased discounting by competitors, putting it in a difficult position.
All right, let's get back to some of the earnings that were crossing the wire just a little while ago. And we want to focus in on Snowflake. Those shares moving lower by about 5% here. The company did provide a revenue forecast that did meet estimates, but, well, investors clearly wanted something more. Mandeep Singh of Bloomberg Intelligence joining us for more. Explain what's going on.
Well, so I think they are in a sector where clearly the market is growing very fast. Their closest competitor, Databricks, which is a private company, is growing north of 60%. So 30% growth and guiding to 22% growth is just not good enough. And with Snowflake, a few things have happened. I mean, they had a management change. Then they had a few breaches involving their customers. AT&T breach was over 100 million customers were impacted. And then finally, Berkshire Hathaway selling Snowflake's stake. That was a big event. So a lot of negatives, and it is reflected in the valuation. I think when it comes to the stock, a lot of the bad news is there. But clearly, they're not rebounding in terms of the top line, which is why you see this sort of a stock reaction.
Yeah, I look at the top line growth rate, 29% for the quarter that just ended. That is the slowest or smallest gain ever, and the first time below at least 30% over the past 4 quarters as well. So you look at a company like Snowflake, is it just tough comparisons and it's going to be a lot harder to execute from here on out?
I mean, look, they're back to their IPO price. So clearly, they were a high growth company throughout, and now the growth is tapering off. But I go back to my original comment. This is a very high growth space. When you think about LLMs and generative AI, every company is looking to deploy generative AI, and Snowflake is a very sticky product. It's just they don't have a clear Gen AI strategy. Are they using someone else's foundational model? Are they developing their own? Now they're talking about developing their own, which everyone is very suspicious about. Like, can you develop a better model than OpenAI and Google Gemini? Probably not.
And the spending, right?
And the spend that requires the CapEx or, the R&D spend. So they probably are better off doing the plumbing in terms of helping organizations customize based on their data, but it's not very clear.
Real quick, we only have about 30 seconds. What would you want to hear on the conference call today?
Just the Gen AI aspect of it. Are they positioning in terms of a co-pilot type of strategy, but then they are competing with Microsoft? So really a lot of clarity around how they plan to migrate their existing customers to a Gen AI type of a product. And I think they have that install base. It's just a matter of having that vision and the roadmap to convince their customers.
Mandeep Singh, as always, really appreciate your jumping on set and talking us through Snowflake's latest results. The stock losing ground right now in after-hours trading. Now, for more on those results from Snowflake as well as Zoom, let's bring in Lindsey Bell, Chief Investment Strategist at 248 Ventures. Lindsey, I just want to back out for a minute here and just get your take on earnings season overall, because believe it or not, it's been almost 6 weeks since the second quarter earnings season began. Headlines began crossing. Has the narrative changed from those early days in July till now?
Well, it's been a good earnings period for the second quarter. The thing that people haven't really focused on or talked too much about is the third quarter outlook. That has come down substantially, which is unusual for the third quarter. Usually the third quarter numbers are settled in by that point of the year. We do end up getting cuts in the fourth quarter just because we always forget about the fourth quarter and have to come back and revise down going into the reporting period. But the revision down is almost 200 basis points in the third quarter, which is a lot driven by those consumer-facing companies, as well as some of the energy and industrial sectors as well. So, but it's been a good earnings season. I just think we're entering a period of slowdown, hopefully before we get a re-acceleration into the end of the year.
Do you see current equity prices taking that slowdown into consideration? I mean, the S&P 500 closed within 1% of an all-time high.
I know, it's wild. I think that we did for a little period of time, but we're right back up to where we were. And so I do think that the valuation here is still a little bit stretched. I'd be wary. I'd make sure you're diversified in your portfolio for sure. But yeah, I think that the valuation is still very stretched, and I do think we need a bit of a reset.
I want to move to another company, and that's Zoom, which came out, of course, the ultimate pandemic darling.
Yeah.
Still obviously relevant in everyone's life. Is it still relevant in terms of actually making money for investors?
Yeah, I mean, that's the question. Yeah. It's very similar to Snowflake. The question is, where does the growth come from here, and how do you integrate AI into this their products, and they're working on doing that. But the question is, what does it mean for total growth overall and their margin picture? And I think the reality is that they're in a highly competitive industry. The question seems to be a question of saturation. They don't have a ton of pricing power. So where do you go from here? And so I think the focus really for Zoom is going to be, is this a quarter that has seen a trough in terms of sales? And can they pick up with their AI products? Can they really start to gain some steam?
Where do we stand, though, in this space? Because it's interesting, we're talking about Snowflake, talking about Zoom. These are kind of the newcomers to the tech space, right? I mean, and I think a lot of people viewed them as kind of the next big thing. These were the next Amazons and Microsofts and Alphabets of the world. Maybe they still are. But in your view, where are those companies? Where are those next big tech behemoths? Are these two them, or should we be looking elsewhere?
I don't know if these two are them. I think they were the first out of the gate in video conferencing and in the data space. But there's a lot more competition now in the space. And so I think that it's all about Gen AI and who can evolve their business strategy to incorporate it not only in their products and services, but how does that then translate into margin and profitability?
Do you see consolidation in this space? I mean, are we in an environment where there's going to be winners buying out, companies that are not in the best position to win, or have regulatory scrutiny made that kind of impossible right now, and the companies just kind of have to slog through this?
I think that will definitely be M&A, but I think it's going to be about acquiring the smaller companies, and I think that acquisition strategy is really going to be about acquiring talent more so than necessarily product or service. Because
kind of like what AMD did with that server company.
Exactly. I was just going to point to that. So I think that was a perfect example of what you can expect more of in this space.
Okay. While a company like NVIDIA is not able to do anything because there's so much scrutiny on it already from regulators in so many different ways.
Yes, exactly. So I think that these smaller companies in the niche markets have a lot of opportunity, not only for acquisition to buy, but also to sell themselves. So there's definitely room.
Where are we kind of in the spending cycle? I mean, we've talked a lot about consumers cutting back, but we're also hearing corporations take a closer look at their own CapEx spend as well here. Does this sort of snowball into something bigger that is going to have a material impact on these tech companies?
So that is something that I'm actually worried about, because CapEx spending has been very good, especially as AI has come into the marketplace. But we are in an election year, and there are tax consequences, tax cuts from the Trump administration that are due to expire. That's going to have impacts on spending. It's going to have impacts on hiring. So this is something that I think that we need to be mindful of, and I do think that corporations and CFOs in particular are being mindful of that now and making spending decisions now into the end of the year. And I wouldn't be surprised to see a bit of a pause on that in the near term.
All right, good stuff. Lindsey Bell, really appreciate your joining us today. Lindsey Bell is Chief Investment Strategist at 248 Ventures. There is some more breaking news that we want to tell you about, and that is Disney has named James Gurman to lead its CEO succession planning committee. James Gurman, the former CEO of Morgan Stanley, who was applauded for really orchestrating a very smooth transition when he handed the reins over to his successor. He is now going to oversee the succession planning at Disney, which has been, let's just say, problematic.
Or non-existent, but which I think is a real issue here. The fact that they actually appointed somebody to do this, the fact that Gurman is the man to do this. I don't know. Some people would question whether that was the right choice, but obviously
really?
He went. Yes, really. And then we talk about this idea here of kind of like who is actually the ideal candidate. Are they going to look internally? Because last time I checked, the bench that they used to have has kind of been thinned out.
Right.
Or do you go externally, and who really wants to step into that job, particularly in the shadow of Iger?
Yeah, and of course, Iger had extended his contract by another 2 years, so it's not as if there's anything happening on that front right now.
We're going to try to get you some more details on this. Disney naming former Morgan Stanley CEO James Gurman to lead the search for a succession to CEO Bob Iger over at Disney. We'll be back in a moment. This is The Close on Bloomberg. All right, continuing to keep an eye on Walt Disney Company. Breaking news right now that James Gurman, the former CEO over at Morgan Stanley, is going to lead the succession planning committee over at Disney. Of course, this is the succession for CEO Bob Iger. Chris Palmieri joining us right now from our Los Angeles bureau. And Chris, talk a little bit here about what they are looking for. We know this has been a long time coming. I was actually kind of surprised to see this headline because I thought they already had somebody sort of overseeing the succession plan already.
Yeah, they did. They brought James Gurman, 13 years CEO of Morgan Stanley, specifically to the Disney board earlier this year because he had a lot of experience in a successful transition. He became chairman of Morgan Stanley, and they said, "Hey, can you kind of help us do the same thing here?" Obviously, after the disastrous, stint of Bob Chapek that brought Bob Iger back to run the company again. So they formed this committee, specifically to look for a new CEO. It's met 6 times in the last fiscal year. And now this is just sort of reaffirming that Gurman is running this process. They have said they're looking at internal and external candidates, but conventional wisdom is it's just a handful of senior Disney executives who are in the running. Companies widely anticipated to name somebody, either a president or a COO, next year who will be the heir apparent.
Right. Good points. And of course, James Gurman had not just the experience of orchestrating his own succession at Morgan Stanley, but having worked at a management consulting firm, this is something that he has, hands-on experience dealing with to begin with. Chris, in terms of the kinds of candidates that Disney is looking to potentially succeed Bob Iger, what has Bob Iger said, if anything, about the succession planning process? Because this was a priority of his when he came back.
Yes, he specifically named it, as said, as one of the list of things that he wanted to do as part of this overall turnaround. Disney's always been a really tricky company because it has so many facets to it. You have people who have to deal with the film business, the TV business, the theme parks, consumer products, and of course this storied brand that means so much to so many people. And so that's why it's been a difficult role to fill. It's also one that nobody ever wants to leave. So it's always been a struggle at succession there, and so they're going to try to make it right this time. Among the things they've been doing is coaching the internal candidates. If you have somebody like Dana Walden, for example, who's come up to the TV business, widely respected in that business, but doesn't necessarily have the chops as a managing a publicly traded giant company like that. So they're all being coached in those sort of broader skill sets. That they would need if they took on as CEO.
Is there any sense of urgency here, Chris? I mean, I know that Iger still has a lot of runway on his contract here, but are investors clamoring for a change sooner than later, or does it not matter?
No, I would think, signs are that Iger's doing what he came to do, cutting costs, improving. They had the first profitable quarter in the streaming business. The movie business seems to be doing better this summer for sure. Yeah. So, I think he's going to stay out his run, and they want him to.
All right, Chris Palmieri out there in Los Angeles. A closer look at Disney now naming James Gurman to head their succession planning efforts to replace CEO Bob Iger. All right, when we come back after the break, we're going to take a look at one of the biggest heists of the 20th century, the pilfering of the Mona Lisa. And here's a question for you, Scarlett, as we go to break. The Mona Lisa is, of course, priceless, but it does have a value ascribed by insurers. What is that insured value?
Hundreds of millions of dollars.
We're going to find out when we come back. This is Bloomberg. All right, let's take a look back in history. On this day, August 21st, 1911, a handyman who had worked for the Louvre hid overnight in a closet at the famed Paris Art Museum. And when the coast was clear, he wrapped it up in his coat, Leonardo da Vinci's 1507 painting, the Mona Lisa. Walking out the door, a plumber unwittingly helping him open the locked front door as he left. The museum was closed that day, so the Louvre wouldn't actually notice the disappearance for more than 24 hours. The thief, Vincenzo Perugia, he had hoped to sell the painting, but the media attention of the heist made it way too difficult. Instead, he hid the Mona Lisa in his apartment, where it sat in a box for more than 2 years before being recovered. And that brings us to our question of the day. How much money would it actually even take to buy the Mona Lisa? The answer? About $1 billion, not including seller's commission, of course. Now, by French law, we should point out the Mona Lisa is technically owned by the people of France and legally can't be sold. However, an insurance assessment back in the 1960s valued it at roughly 100 million US dollars. On an inflation-adjusted basis, that's about $1 billion today. But here's a fun fact. At the time of the heist in 1911, the painting likely was only worth about $5 million. Still pricey, but not priceless. That's because the Mona Lisa was then considered to be one of Da Vinci's lesser works. But after it went missing, the story blew up, and the crowds now wanted a glimpse of the once pilfered painting. It went viral. The public attention so high that before the police returned the painting to the Louvre, it had to be paraded throughout Europe. And now it is back in its rightful place, the Mona Lisa remaining the marquee attraction among the more than 35,000 items on display at the Louvre, one of the world's most famous and valuable pieces of art.
Interesting story. I never knew any of that. And by the way, there is a great Bloomberg opinion column from Howard Schwad-Yuan about how if you want to go see the Mona Lisa as part of your bucket list, maybe skip that and go for something else. He has a recommendation for another Da Vinci painting, which is Lady with an Ermine, which he recommends.
Have you been there? I saw it too.
To the Louvre or to see Lady with an Ermine?
Specifically to see the Mona Lisa.
Yeah, but you just see cameras lifted aloft, right? I mean, you don't actually see her.
Yeah, well, once you get to the front, but then it was so small and it was so far away. I was like, okay.
You moved on. Yeah. All right, let's move on now to earnings because we've been hit with a wave of earnings. So we wanted to give you a roundup of some of the notable movers. Let's bring in Bloomberg's Bailey Lipschultz, Abigail Doolittle, and Jess Menton. Bailey, let's start with you on Urban Outfitters.
Urban Outfitters, yeah, Scarlett, down about 3%. It's been choppy. Post-market trading popped up closer to 4%, now trading slightly in the red, still light volume. This coming after net sales were modestly in line with most of what Wall Street was looking for. I do want to call out a bit of weakness as it relates to net sales as well as comp sales for their Anthropologie unit, so the parent company of Anthropologie as well as Urban Outfitters, under a bit of pressure, but when you take it into consideration, the stock was up about 3% on the day, so really trading unch relative to where we were this time yesterday. Focus will be on earnings call. On the earnings call will be around gross margins, which were better than analysts had been expecting, but keeping an eye on, again, comp sales worse than mostly were feared as it relates to Urban Outfitters, Anthropologie, and some of their other stores. But again, thin trading, very much a summer afternoon here as it relates to Urban Outfitters. Abigail, what are you looking at?
Well, I'm taking a look at the shares of Wolfspeed, which are really literally doing nothing, and this is not the expectation. The expectation via options had been for a move that would be 20% up or down. But right now, investors seem to not be able to decide what they think about the quarter. Now, there was a bit of a miss. The loss was wider than expected. Sales missed ever so slightly. The guide, however, for the current quarter must be a little bit better. Well, now it's down 3%. But again, relative to the expectation of a 20% move up or down, really not doing all that much. And in fact, take a look at some of the Wolfspeed VO that we have here, probably more exciting than what the stock is doing. There is a 19% short interest on the shares of Wolfspeed. So stay tuned. We'll be watching tomorrow to see what investors think about that small miss and the guide that maybe is a bit in line. Jess, what are you taking a look at?
I'm taking a look at Synopsys. So this is actually an application software company. It is in the S&P 500. It has a market cap actually close to about $87 billion. So when you look at this, and especially because companies like to go to this type of company to test out some of the chip manufacturing it has before it ends up manufacturing that equipment. If you look at this, though, it stocks up about 1% in after-hours trading. A lot of that wasn't just because it beat on that prior quarter's results, but when you look at the fiscal year EPS estimates coming in around $13.07 and $13.12 for the fiscal year, so coming in above those median expectations from analysts and the consensus here in the Bloomberg terminal. But if you look at SERP, that's basically telling you the options implied volatility for this stock could swing about 5% in either direction, but you are seeing this hold on to the gains. So basically on this call, investors want to hear about what the future holds as far as what it means for its gross margin outlook, because it was in talks a couple months ago to basically sell its security side of business there and what that means moving forward, guys.
Jess Menton, Abigail Doolittle, and Bailey Lipschultz. A nice roundup of some of the earnings that we've gotten here in after hours training as that earnings season begins to wind down. More than 400 companies in the S&P have reported so far. For a breakdown of how things went, let's go to Michael Casper, Bloomberg Intelligence analyst here. Kind of sum this up for us here. We've pretty much seen all we need to see. I know we still got NVIDIA out there, but give us a sense. Do you think this was a good quarter?
I think it was a great quarter for the S&P, especially. We're tracking about 14% EPS growth versus the 8.3% expectation. On the Russell 2000 side, there's a little bit more to be desired. I mean, revenue growth was expected to be about 2.5%. We're tracking 3%. So overall, a great earnings season for the S&P 500, a little bit better than the past few for the Russell 2000, but hoping for things to tick up a little bit in the small cap space.
If you had to give a letter grade to S&P 500 earnings and Russell earnings, what letter grade would you give?
I think overall, just weighting the S&P heavier, I think it's an A earnings season. The reason it's not an A plus, I would say, is because there's still a few sectors out there that are in earnings declines. Mm-hmm. Materials is the one that comes to mind. But I think, overall, anytime you're about doubling the EPS growth expected at the beginning of the season, it's hard to give it anything lower.
It doesn't feel like an A, and I wonder what it looks like coming up, given you've got some more difficult comparisons.
Yeah, so the reason you might not think it's an A, I would say, is because some of the tech and tech-related names like Microsoft comes to mind, Google comes to mind. They had slight misses in certain segments, and the price reaction wasn't great to their earnings. But overall, I mean, you've got a pretty healthy breadth of sectors adding to the EPS growth picture. And on the comparisons front, yes, EPS estimates are coming down for the next 4 quarters, but they're actually coming down less than they historically do. Typically, consensus goes in and trims on the edges EPS forecasts for the next few quarters. So everything's still looking fine there.
All right, trimming along the edges. I like the way you put that. Michael, really appreciate you joining us. Michael Casper of Bloomberg Intelligence. We've been tracking earnings. We got the roundup earlier. And of course, there's a slew of earnings due out tomorrow, including Kava, Intuit, and Ross after the closing bell. But before the market opens, we're going to hear from BJ's Wholesale and Advance Auto Parts. So just to give us a little bit of a preview into what we might expect, let's bring in Kate McShane. She is Managing Director at Goldman Sachs. Kate, I want to start with Advance Auto Parts because it's so interesting when you have the car makers themselves kind of struggling to figure out their strategy, given what Ford said, for instance, today. What are you thinking in terms of how investors should position for what Advance Auto Parts is likely to tell us?
Yes, thank you for having me. With regards to Advance Auto Parts, I think if we start with just the industry outlook, aftermarket retail is really dealing with repair. And so it's not necessarily predicated on how many cars are being produced. It's really being driven by the age of cars and also the miles driven. So just all the wear and tear you do on your car. And so as we've come out of COVID, we still are seeing an increase in miles driven. And because of the supply chain issues with both new car and used car, the average age of cars have gone up to almost 12 years, I think actually above 12 years now, after hovering around 10 years as an average age about 5 to 7 years ago. And so the tenets of what drives the industry is actually pretty healthy. For Advance Auto Parts, though, this is a company that has been struggling from a competitive standpoint. They have a new management team in place currently that is looking to right the ship. We do expect tomorrow to continue to see more pressure, in the business, despite somewhat decent industry fundamentals, as the company starts to improve its strategy.
Well, talk a little bit more about their cost structure, though, Kate, because, investors seem to be really concerned here about those operating expenses going up. And then I remember seeing something, I think it was on the last call a quarter ago, where they were actually talking about becoming more competitive on pricing.
Yes, that's absolutely right. And so one of the areas that the company has not been competitive with is their pricing. They were too expensive relative to their competitors like O'Reilly and AutoZone. And so one of the things this new management team has come in to do is to really get pricing back into the competitive set. They're not really looking to beat on price. It's a very rational pricing environment, but they are looking to be more competitive, taking price points that are above average for the industry and bringing them in line to average price. That takes a lot of investment. It takes a lot of vendor negotiation. And where we're going to see it most this year is in the second quarter, which is the quarter that they're reporting tomorrow.
I also want to get your take on BJ Wholesale because you've got a buy rating on that stock with a price target of $95. It closed today at about 87 and change. Are we going to hear something similar to what we've heard from Walmart, from Costco, from Target, where consumers want value and they're finding it in those bulk wholesalers?
Yes, so BJ has all of those same tenets as Walmart, Costco, and Target do, in that they offer the consumer quite a bit of value. They do it through their membership program. They're a club model, just like Costco and Sam's Club. And what that membership allows them to do is allows them to be very competitive on price. Their prices, on average, are about 25% lower than what you'd find in a typical grocery store. So they definitely have that value that Target and Walmart talked about the last couple of days that the consumer is looking for. In addition to that, they do sell a lot of food. 80% of what they sell is grocery. And with there being so much inflation in grocery, the value-seeking behavior of those consumers has been more so and has contributed to both very strong membership growth at BJ's as well as stronger comp growth as well.
When we talk about the growth in these sort of, I guess, value or discount type of stores, so they are pulling in new customers, meaning the type of people who had never shopped at a BJ's or Costco or whatever, Walmart in the past. You're saying that these companies are seeing new people come into the door.
Yes, they are. And I think probably, the best example to give without going too far off of BJ's, but one company that's talked the most about it is Walmart. You have seen their income demographic for their consumer once skew much lower income consumer, and now it's skewing a little bit higher income consumer. So think $100,000 a year in income or more. And that is what a lot of retailers are seeing, is that $100,000 income is coming more to these discount club broadline retailers.
Everyone wants a deal. Kate, really appreciate your joining us today. Kate McShane is managing director at Goldman Sachs. And, I was just looking at BJ's and comparing it to Costco. BJ's trades at 22 times earnings.
Yeah.
Guess how much Costco trades at?
I don't know, 70.
54 times.
So this is interesting, too. I don't know if you saw this, but I thought of you this morning. The New York Times had a great piece today about Costco. I'm just going to read you the headline. Yes, you're like a platinum member or something like that.
Yes, I am.
It says, how Costco hacked the American shopping psyche. There was a lot of great reporting in this, including the fact they said a third of American shoppers shop at Costco, which seems like a large amount.
You're part of the 2/3 that don't.
Yeah, I am, and I've never set foot in a BJ's, and I've been in a Walmart twice, and once was to use the bathroom.
I like the fact that I can get a gigantic canister of Tide Pods, and if I want to buy vinegar, I can get like 6 of them at once.
This is what you're getting there, Tide Pods and vinegar?
Yeah, well, I have to. I'm sending my kid off to college, so he needs some Tide Pods. Yeah.
Okay. Well, I thought you were going to keep the Tide Pods at home when he brings his laundry home for you to wash.
No, he's going to take care of that.
But it gets to this idea, too, of like the appeal. And one thing I thought was great about the article was they talked about, obviously, a lot of people go there for the value. But they said it's just much bigger than that, right? It's almost cultural in a sense here, and the certain kinship and the idea that this is just kind of part of the American side.
Well, it's kind of like TJ Maxx in that you go there and you don't know what's going to show up there. And so if you see it at Costco, you got to buy it right away because it might not be there the next time you come back. The turnover is so quick. It's super quick. Like if you decide that you don't want to get it, I'll just buy it next week. You come back, it won't be there. I know, I'm a platinum shopper at Costco.
Okay, well, I know if I need something from Costco, I'll just piggyback on your platinum status.
No, oh my God, they're checking all that. It's like Netflix. They're making sure
really?
they can't.
So I can't just piggyback.
No, you can't borrow my ID. Yeah. All right, let's take a look at how markets closed on the day. To some people, I'm sure we do. The S&P 500 closing within 1% of a new record high. Didn't quite get there, but up 0.4%. And retail, really an outperformer here, even as we saw Macy's tick down by double-digit percentages. Nothing to add?
Nothing to add, Scott.
Nothing to add. All right, that does it. This is the close on Bloomberg.
All right, the third full day of the Democratic National Convention is underway in Chicago with Vice Presidential nominee Tim Walz set to deliver his acceptance speech tonight. Also expecting a special performance from John Legend and Sheila E., a tribute to Prince in honor of Waltz's Minnesota roots. But what beyond that glitz and glamour? A lot of questions here about the policies here of the Democratic ticket. Heidi Shierholz joining us right now, president of the Economic Policy Institute, to talk a little bit more about what to expect. And Heidi, we've gotten a little bit of a taste here of what a Harris-Walz administration might look like on the economic front. When you look at some of the policies that they put out so far here, is it going to be a significant departure from what we've seen under the Biden administration?
I think it will be a huge departure, right? We're getting more and more details out every day. There's more things that Harris is focusing on that I think is some of the unfinished business of the Trump administration. Like I think there'll be, the unfinished business of the Biden administration. Like Biden had a big attempt to increase investments in the care infrastructure, things like, universal pre-K, universal early child care, investments in home and community-based services, which is essentially elder care, paid sick leave, paid family and medical leave, that portfolio of things that would kind of bring us into the modern global economy. Our peer countries around the globe all have those things, and they are much better off for it. So I think that's an example of one of the things that she would see as president as unfinished business from the Biden administration that we need to move on in a new Harris-Walz administration.
Well, let's talk about how that gets implemented, because, of course, some of these proposals that they have to do just what you said, of course, are going to come either with increased taxes or other increased costs to the federal government, or at least to some of the taxpayers here. When you're doing your economic analysis here, I mean, give us a sense here as to whether it makes financial sense. We can definitely talk about whether it makes sort of moral or ethical sense or practical sense, but financially, does it?
Those kinds of care investments really, really do make good financial sense. I mean, some of them have like the universal pre-K has such strong return on investment that it will actually reduce the deficit. I mean, sure, the deficit reductions come 15 years later, but who better than the federal government to make those kinds of investments rather than leaving that money on the table? Some of the other investments don't have that kind of return on investment, but are incredibly important for maximizing labor force participation. The U.S. has been left in the dust as far as labor force participation goes compared to our peer countries around the globe who have done these kinds of things, and that in particular has drawn women into the labor force.
All of this, of course, is a wish list. It all depends on what Congress will do with whatever administration takes office. So I wonder, in terms of the actual practical things that will be addressed, I feel like the Trump administration tax cuts will be something that action will be taking on one way or another. Walk us through how a Harris-Walz administration would deal with that, given that there's this SALT cap that Chuck Schumer, the senator from New York, wants to, do away with, but clearly does bring in revenue for the government.
Yeah, so there's many of the Trump provisions and the TCJA, the Trump tax cuts, are expiring in 2025. The expiration dates were put into the law in order to make it seem cheaper than it was when they enacted it in 2017. So many of those, I think I got the date wrong, but when they enacted it, so many of those provisions are expiring. Notably, the corporate tax cuts are not expiring, but many of them are expiring. And so there will be a big fight on taxes in 2025. One of the things that I know that the vice president has said is that there will be a real focus on increasing revenue through increased taxes on the wealthy, on the rich. She has continued the Biden pledge of we're not going to raise taxes on people who make less than $400,000 a year. But again, to look at our global, the global comparisons, our peer countries around the globe have increased the kind of public goods and social insurance that make an economy that really works for working families, works for everyone, and they have done it through increasing taxes. We, as the United States, our federal revenue as a share of GDP is roughly now where it was 70 years ago. We have not made any progress. And so I think to do the kinds of things we want to do, while also bringing down deficits, it's time to really lean into the revenue side of things, and particularly in having the wealthy pay their fair share.
It always comes down to cutting costs and raising revenue at the same time. It can't be just one or the other. Heidi Shierholz, thank you so much. President of the Economic Policy Institute.
And we should just mention, too, just as a clarification, Heidi, of course, also did serve during the Obama administration, chief economist at the Department of Labor during his first term.
That's a really important claim. Thank you for including that. You mentioned John Legend and Sheila E. will be reporting.
Yes, I'm excited about this
singing.
now. I love John Legend, Chicago, pride of Chicago.
Yeah.
Although technically he's from Ohio, but we'll claim him for Chicago. And then Sheila E. Come on now. I mean, you'll never remember that. One of the best performances I ever saw, it was at the American Music Awards, and Sheila E., the lights went down, and it just her drumsticks glowed, and then she was playing
I'm going to look that up on YouTube.
All right, we're going to talk about this during the break here, and hopefully the conversation will continue when we come back. This is Bloomberg. All right, let's get to it. Some of the potential market-moving events over the next 24 hours, and we start before the market and some earnings, Scarlett.
Yeah, BJ's Wholesale and Advance Auto Parts both reporting, so another read on the consumer.
And we also get some earnings after the bell that could also give us additional insight on the consumer.
Kava Group, the restaurant company, Intuit, and Ross Stores.
And economic data, weekly jobless claim. I don't know, is this going to be as scintillating as those job revisions that we got this morning?
I don't think the numbers will be anywhere close to what we got this morning, but we also get existing home sales.
Yeah, existing home sales. We also get some of that PMI data here. I know the manufacturing sector not quite as important to this economy as services and consumer spending, but something to keep an eye on. And then, of course, the penultimate night of the Democratic National Convention. We're going to hear from the vice presidential candidate, Tim Walz.
Unlike prestige TV series, this will not be the most exciting night. The most exciting night has to be the finale.
It's supposed to be,
yes.
Right? All right. And Balance of Power, which is coming up next. We'll have full coverage of that right here on Bloomberg.